So many people have deferred a significant chunk of their income to traditional retirement accounts, traditional 401ks, traditional 403bs, traditional IRAs. And while that has a benefit, especially if you're in a high income earning year in comparison to retirement, let's say, what does that mean? You have an impending tax liability. You're lacking something. And that something is diversification, but not the traditional diversification. Tax diversification. Tax diversification through Roth monies. And this presents a few challenges. Number one, if tax rates go up, we're in a historically low tax environment. So if for whatever reason our government gets together and says, yeah, we should probably start chipping away at that deficit, one of the ways might be raising taxes. So if you've just deferred all this income your whole life, you might have to pay more tax as a result of higher tax rates. And number two, required minimum distributions. At some point, you will be required to take monies from your traditional accounts. You don't have to do that with Roth monies. There are no required minimum distributions. And number three, if your income is just higher later in life as a result of all these different income sources, such as Social Security, which isn't present earlier. And I know people joke and laugh about Social Security, but it is a decent amount of income that you'll have to take later in life if you've been paying into the system. You could just be in a higher tax rate. So you might be paying more tax as a result of just making more money in retirement than you would have if you just would have paid those taxes earlier. So if you move to a state with no income tax, you don't have to pay state income taxes on Roth conversions, potentially saving you huge dollars if you implemented the strategy effectively. So it works in a relatively straightforward manner. You can take any amount of your traditional IRA and convert that into a Roth IRA. Okay, so sometimes there's a misunderstanding here that you have to convert your entire traditional account to your Roth IRA. That's not the case. But often where I like to consider this is in what I refer to as a gap period. So if you have an early retirement, if you have a sabbatical, if for whatever reason your income is otherwise lower than it normally would be, these are all great opportunities to consider a Roth conversion. And of course, if you're converting that in a state where you don't have any income taxes, you don't have to pay any income taxes on that conversion. But I always like to model this out. We always will model this out at Mariner Wealth Advisors because we want to bring, again, a quantitative measure to an otherwise qualitative thought rather than just giving generic advice.